Imagine waking up tomorrow morning, grabbing your phone to check the silver price, and what you see doesn't make any sense. The number isn't $30, it isn't $40, it isn't even $50. It's hovering close to $60, maybe even $70 an ounce. Your heart starts pounding because just yesterday, silver was trading at 30. You rub your eyes, refresh the page, and the number stays the same. Then you look at the percentage move and you realize that silver hasn't just gone up a little bit, it has doubled in a single session, sometimes in a matter of hours. People on social media are losing their minds. Your phone is blowing up with messages. The news anchors look confused because they don't understand what just happened. But you understand because you have been following shadow wealth for a while now, and you know that what you are witnessing is not some random glitch in the matrix. What you are witnessing is the collapse of the COMEX, the most important commodities exchange in the entire world, and the beginning of a completely new era for silver. But before we go any further, if you are serious about protecting your wealth and staying ahead of these massive market moves, hit that like button right now, subscribe to Shadow Wealth, and turn on the notifications so you never miss an alert when the system starts to crack. Trust me, the signs are already everywhere, and most people are walking around completely blind to what is coming. Let me take you back to a conversation I had with a trader a few years ago, a guy who had been working on the COMEX floor for over 2 decades. We were sitting in a quiet coffee shop in New York, and he leaned across the table and lowered his voice like he was about to tell me a secret. He said, "You know, the silver market is the biggest lie in finance." I asked him what he meant, and he smiled and said, "There is more paper silver trading on the COMEX every single day than all the physical silver that has ever been mined in human history." Think about that for a second. Every day the COMEX trades hundreds of millions, sometimes billions of ounces of silver on paper, in the form of futures contracts. But the actual physical silver sitting in the COMEX vaults, the real bars that you could actually touch and hold, that number is only around 120 million ounces on a good day. That means for every 1 physical ounce of silver that actually exists inside the COMEX system, there are hundreds, sometimes thousands of paper claims on that same ounce. This is what insiders call the rehypothecation chain, and it is the most fragile, most dangerous, most unstable structure in global finance. Now, here is where Shadow Wealth wants you to really pay attention, because this is the part that most analysts get completely wrong. They will tell you that the COMEX is just a futures exchange, that it is just a place where miners and industrial users hedge their risk, that the paper market is simply a tool for price discovery. But that is not the full story. The truth is that the COMEX has become the central pricing mechanism for silver across the entire planet. Every refinery, every mint, every bullion dealer, every central bank, every ETF like SLV, they all look to the COMEX futures price to set their own prices. So when the COMEX price crashes, physical silver crashes with it. And when the COMEX price soars, physical silver soars too. But here is the catch, and this is the most important thing you will learn today. The COMEX price is not determined by the forces of supply and demand in the physical market. It is determined by a small group of large banks and hedge funds who trade massive amounts of paper contracts, often without ever intending to take delivery of a single ounce of real silver. They are trading digits on a screen, and those digits dictate the price of a real, tangible, finite commodity that is used in everything from solar panels to smartphones to medical equipment. So what would actually cause the COMEX to collapse? This is not some fantasy scenario that only conspiracy theorists talk about. This is a real risk that the people running the exchange have been warning about quietly for years. The collapse would begin with a simple event, a delivery demand that the system cannot handle. You see, every COMEX silver futures contract gives the buyer the right to take physical delivery of 5,000 ounces of silver. Most of the time, traders close out their positions before the delivery date because they do not want to deal with the hassle of taking delivery. They just want to speculate on the price. But what if, and this is the key, what if a large number of traders suddenly decided to take delivery at the same time? What if a few big players, maybe a sovereign wealth fund, maybe a group of wealthy investors, maybe even a central bank, decided to buy a bunch of COMEX contracts and actually demand the physical metal? This is called a delivery squeeze, and it is the nightmare scenario for the COMEX. Let me paint you a picture of how this would unfold. It starts on a normal Tuesday morning. The COMEX opens for trading, and the silver price is hovering around $30. But within the first hour, someone starts buying an unusually large number of December futures contracts. The volume is so high that the floor traders start whispering to each other. By lunchtime, the price has moved up $1, which is a big move, but nothing crazy. Then the next day, the same buyer comes back, and this time they are buying even more contracts. The price jumps another $2. The hedge funds that are short silver, and there are always a lot of them, start to get nervous. Their risk management systems are flashing red. Some of them start covering their shorts, which pushes the price even higher. By the end of the week, silver is trading at $36. The news starts paying attention. The financial channels bring on the usual talking heads who say it is just a short squeeze, that it will reverse soon, that nothing to see here. But then something happens that changes everything. The first notice day arrives. This is the day when buyers of COMEX futures contracts have to inform the exchange whether they intend to take physical delivery or just settle in cash. Under normal circumstances, over 99% of traders choose cash settlement. But this time, the numbers come in, and they are staggering. Instead of the usual few hundred contracts standing for delivery, there are 10,000 contracts standing for delivery. Do the math with me. 10,000 contracts times 5,000 ounces per contract equals 50 million ounces of silver that must be delivered. 50 million ounces. The entire registered silver inventory on the COMEX at that moment is maybe 60 million ounces. So almost the entire available supply is spoken for by just this one group of buyers. The exchange officials start making frantic phone calls. They call the big bullion banks like JP Morgan and HSBC and ask them to lend silver to cover the shortfall. But the banks are not stupid. They know that if they lend out their silver, they might not get it back because the price is exploding higher. They start demanding higher and higher collateral. Some of them simply say no. Now the panic really begins. The COMEX has a rule that in the event of a delivery failure, they can declare a force majeure, which is a fancy way of saying sorry. We cannot deliver the silver, so we will just settle your contracts in cash at the current market price. But here is the problem. The buyers do not want cash, they want the silver. They have been planning this for months, maybe years. They have storage facilities ready. They have armored trucks on standby. They want the physical metal, and they are willing to go to court to get it. The moment the COMEX announces that they cannot deliver, the entire paper silver market loses credibility. If the biggest commodities exchange in the world cannot honor its contracts, then what is the point of trading futures at all? The price of silver on the COMEX immediately gaps up by another $10 because the market realizes that the paper price has been disconnected from physical reality for decades, and that disconnect is about to be violently corrected. This is where the overnight double becomes not just possible, but almost inevitable. Let me walk you through the mechanics. As the news of the delivery failure spreads around the world, it hits Asia first because of the time zones. When the Tokyo and Shanghai markets open, the first thing traders do is check the COMEX price from the night before. They see that silver is at $46 and that the exchange is in chaos. But here is what they also see. The physical silver market in London, the LBMA, is still functioning, and the physical price there is already at $52 because the LBMA actually requires physical metal for most of its trades. So now you have a situation where the COMEX paper price is $46. The LBMA physical price is $52, and the gap is widening by the minute. Arbitrage traders jump in to buy the cheap COMEX paper and sell the expensive LBMA physical, but they quickly realize that they cannot take delivery of the COMEX paper, so the arbitrage does not work. The two markets decouple completely. By the time the New York session opens again, the sentiment has shifted from panic to outright fear. Every hedge fund that was short silver, and there are billions of dollars worth of short positions, is facing margin calls that they cannot meet. Their brokers force them to buy back their shorts at any price, which is like throwing gasoline on a fire. The price hits $50, then $55, then $60. By the end of the second day, silver is trading at $65 on the COMEX, more than double where it started just a week earlier. But here is where Shadow Wealth wants you to understand the full scope of what happens next, because the doubling of the price is not the end of the story. It is just the beginning. Once the COMEX collapses and the paper price doubles, the physical market goes absolutely ballistic. Remember all those silver ETFs like SLV that hold physical silver in London vaults? They start trading at massive premiums to their net asset value because investors realize that the ETF shares are actually backed by real metal, and that real metal is now worth way more than the COMEX price suggests. The premiums go from a few percent to 20, 30, even 50% above the spot price. The big bullion dealers like APMEX and SD Bullion see demand that they have never seen before. Their websites crash from the traffic. Every single silver coin and bar on their shelves sells out within hours. The mints, the US Mint, the Royal Canadian Mint, the Perth Mint, they are all running at maximum capacity, but it is not enough. They start rationing sales. Some mints announce that they will only sell to existing customers. Others raise their premiums to insane levels, $50 over spot for a 1-ounce coin. And the secondary market, places like Craigslist and Facebook Marketplace, turn into a frenzy. People who bought silver at $20 an ounce a few years ago are now selling at $60, $70, $80 to people who are desperate to get their hands on anything that is not paper. Now I know what some of you are thinking. You are thinking that this sounds like a fantasy, that something this dramatic could never happen in the modern financial system. But let me tell you about a little event that happened in 2020, the March crash. When COVID hit, the entire world shut down. The COMEX had a mini version of this exact scenario. The price of gold and silver crashed initially because of a rush for cash, but then something strange happened. The physical market completely disconnected from the paper market. The COMEX gold price was trading around $1,600, but physical gold bars were selling for $1,800, sometimes $1,900 because the refineries in Switzerland had shut down and no one could produce new bars. The premiums on gold coins went to 30%, unheard of levels. And silver, oh boy, silver was even crazier. The COMEX silver price dropped to $12, but physical silver was selling for $18 to $20 because the biggest silver mine in the world had shut down in Peru, and the second biggest had shut down in Mexico. The arbitrage between paper and physical was massive, and it took months for the markets to realign. That was just a temporary supply shock. Imagine if that situation lasted for years instead of months. Imagine if the problem was not a temporary shutdown of refineries, but a permanent realization that the paper market had been overstating supply for decades. Let me give you another example. The London Metal Exchange nickel crisis of 2022. This is the closest thing we have seen to a COMEX collapse in recent history. In March of 2022, the price of nickel on the LME doubled in a matter of hours, from around $30,000 a ton to over $100,000 a ton. Why? Because a large Chinese producer, Tsingshan, had a massive short position in nickel, and when the price started moving against them, they could not find enough physical nickel to deliver. The LME did something unprecedented. They canceled trades, they suspended the market for over a week, and they effectively rewrote the rules to save the big players from blowing up. Sound familiar? That is exactly what would happen if the COMEX faced a delivery squeeze in silver. The exchange would try to change the rules, they would try to settle in cash, they would try to do anything to avoid a default. But here is the difference between nickel and silver. Nickel is an industrial metal that is used mostly in stainless steel and batteries. Silver is monetary metal. Silver is money. Silver has been used as money for 5,000 years. People have an emotional, almost primal attachment to silver in a way that they do not have for nickel. So when the silver market cracks, the reaction from the public will be 1,000 times more intense than what we saw with nickel. Regular people who have never thought about silver in their lives will suddenly want to own it because they will see it on the news and hear that it is going up, and they will not want to be left behind. That is when the real mania begins. Now let me bring you back to the central question of this entire discussion. Why is this collapse likely to happen sooner rather than later? What has changed in the last few years that makes this scenario more probable today than it was 5 or 10 years ago? The answer is simple, and Shadow Wealth has been talking about this for a long time. The physical silver market has been in a structural deficit for 3 years in a row. That means the world is mining less silver than it is using in industrial applications, solar panels, electric vehicles, 5G networks, medical devices, water purification systems, you name it. The deficit in 2021 was about 50 million ounces. In 2022, it was over 80 million ounces. In 2023, it was more than 100 million ounces. And the forecasts for 2024 and 2025 show the deficit getting even larger. Where do you think the COMEX gets its silver to fill those delivery requests? They get it from the same global supply that is already being consumed by industry. So, when a delivery squeeze happens, there is no spare silver sitting around in some magical vault waiting to bail out the exchange. The spare silver does not exist. The world is consuming every ounce that comes out of the ground. And then some. The COMEX inventories have been falling steadily for years, from over 300 million ounces a decade ago to less than 100 million ounces today. The trend is clear. The silver is leaving the building, and it is not coming back. I want you to imagine the psychology of the people who run the COMEX. These are not stupid people. They know exactly how precarious their position is. They know that the ratio of paper claims to physical metal is absurd. They know that a determined buyer or group of buyers could bring the whole system down. That is why they have changed the rules over the years to make it harder to take delivery. They have increased margin requirements, they have shortened delivery windows, they have added fees for taking delivery, and they have made it harder for small players to participate. But here's the thing about rules. They only work as long as everyone agrees to follow them. When a buyer shows up with enough capital and enough legal firepower, those rules start to look very flimsy. And there are buyers out there right now, you do not know their names, they do not want to be in the news, but they are accumulating silver quietly, steadily, patiently. They are not buying paper futures. They are buying physical bars, physical coins, physical rounds. They are taking delivery and putting the silver in their own vaults far away from the reach of the COMEX. They are playing the long game, and when they decide to strike, the COMEX will not see it coming until it is too late. Let me tell you a story that illustrates this perfectly. There is a well-known investor, let us call him the Whale, who has been buying silver for over a decade. He started in 2010 when silver was trading around $20. He bought millions of ounces, not through the COMEX but directly from mints and refiners. He took physical delivery, stored it in multiple locations around the world, and just held it. Everyone laughed at him for years. They said he was crazy, that silver was a relic, that it had no future. Then in 2020, when silver went from $12 to $30, the Whale started selling a little bit, but just a little bit. He told his friends that the real move had not even started yet. In 2023, he added to his position again when silver dropped back to $20. Today, that Whale is sitting on millions of ounces of silver with an average cost below $15. If the COMEX collapses and silver doubles overnight to $60, that Whale makes a fortune, a life-changing, generational fortune. But here is the part that the Whale understands better than anyone. He is not going to sell when silver hits 60. He is going to hold for 80, for 100, for $200 an ounce, because he knows that once the paper market collapses, the only price that matters is the physical price, and the physical price has no ceiling. It can go to whatever level the market will bear, and the market will bear a lot when people realize that paper money is losing value every single day. Now, I want to talk about the role of the banks, because the banks are the ones who have created this fragile system, and they will be the ones who suffer the most when it breaks. The big bullion banks, JP Morgan, HSBC, Scotiabank, they have been running a massive fractional reserve silver market for decades. They sell silver futures contracts to their clients, to hedge funds, to miners, to anyone who wants to speculate on the price, but they do not have enough physical silver to cover all those contracts. They rely on the fact that most traders will never take delivery. It is exactly like a bank that lends out more money than it has in deposits. As long as everyone does not ask for their money at the same time, the system works. But if everyone asks at the same time, the bank fails. That is called a bank run, and a COMEX delivery squeeze is the silver equivalent of a bank run. The only difference is that when a bank fails, the government steps in with deposit insurance and bailouts. But when the COMEX fails, who steps in? There is no deposit insurance for silver futures. There is no lender of last resort for a commodities exchange. The COMEX is on its own, and if it cannot deliver the silver, it will default. And a default by the COMEX is not like a default by some small company. It is the default of the most important precious metals exchange in the world. The shockwaves will be felt in every financial market on the planet. Let me give you a sense of the scale of what we are talking about. The total value of silver traded on the COMEX every year is in the trillions of dollars. The total value of physical silver that actually exists above ground is maybe $200 billion, and most of that is already held in jewelry, silverware, and industrial products, not in investable bars and coins. So the investable silver market is maybe $50 to $60 billion. That is tiny. For comparison, the market capitalization of Apple is over $2.5 trillion. So the entire investable silver market is about 2% the size of Apple. That means it does not take a lot of money to move the silver market. If a few $1 billion worth of investors decide to take delivery of physical silver, they can drain the COMEX vaults in a matter of weeks. And there are pension funds, sovereign wealth funds, and family offices out there with trillions of dollars looking for assets that are not correlated to the stock market. Silver, physical silver, is one of those assets. It does not have counterparty risk. It does not depend on the promises of a bank or a government. It is just a bar of metal that you can hold in your hand. When the next crisis hits, and it will hit, those big money managers are going to look at silver and see something that no other asset class can offer. True. Absolute physical safety. I want you to think about the concept of leverage for a moment. The silver market is the most leveraged market in the world, but not in the way you might think. The leverage is not just in the futures contracts. It's in the entire pricing structure. Every ounce of physical silver in the COMEX vaults is backing hundreds of ounces of paper claims. That is leverage of 100 to 1, sometimes more. So when the physical market tightens, that leverage works in reverse. A small increase in physical demand can cause a massive increase in the paper price, because the paper claims are fighting over a tiny pool of real metal. That is why silver can double overnight. It is not because the fundamental value of silver has changed. It is because the paper pyramid has collapsed, and the paper price is rushing to meet the physical reality. And physical reality right now is that silver is incredibly cheap relative to almost every other asset. Let me put it in perspective. The gold to silver ratio, which is the number of ounces of silver it takes to buy 1 ounce of gold, is currently around 85 to 1. The historical average is about 40 to 1. In times of monetary stress, the ratio has gone as low as 15 to 1. So if the ratio simply returned to its historical average, silver would be at $60 an ounce with gold at $2,400. If the ratio went to 30 to 1, which is not extreme, silver would be at $80 an ounce. If the ratio went to 15 to 1, which happened in 1980 and again in 2011, silver would be at $160 an ounce. Do you see why the upside is so massive? Do you see why the smart money is accumulating silver even at current prices? Now let me address the skeptics, because I know there are some of you watching who think this is all doom and gloom, that the system has survived for decades, that it will survive forever. I want you to consider the following. Every single financial system that has ever existed based on fractional reserves, whether it is a bank, an exchange, or a whole economy, has eventually failed. It is not a matter of if, but when. The Roman denarius was debased until it became worthless. The French livre collapsed during the Revolution. The German mark hyperinflated in the 1920s. The Bretton Woods system ended in 1971. The COMEX silver market is just the latest in a long line of paper promises that cannot be kept. The only question is whether you will be prepared when the music stops. Will you be holding paper promises, or will you be holding physical metal? Because when the COMEX collapses, the people who hold the physical metal will be the ones who set the price. The people who hold the paper contracts will be the ones who get settled in cash that is losing value by the minute as the monetary system reacts to the crisis. I want to take you inside the mind of a COMEX trader on the day that the collapse happens. His name is Mike, and he has been trading silver futures for 15 years. He wakes up at 5 in the morning, checks his phone, and sees that silver is up $3 overnight. He is not worried because he has seen big moves before. He drinks his coffee, drives to the office, and sits down at his trading desk. By 9 o'clock, silver is up another $2. His risk limits are getting tight, but he is still okay. By 10 o'clock, the volume explodes. Somebody is buying every contract in sight. Mike looks at his screen and sees that the bid-ask spread has widened to $1, which is insane. Normally the spread is a penny or two. He tries to hedge his position, but the market is moving so fast that his orders are getting slipped by dollars, not cents. By 11 o'clock, his firm is down $10 million on the day. His boss comes over and tells him to cut his losses. Mike starts selling, but every time he sells, the price drops, and then it immediately recovers because the mystery buyer is still there, still buying. By noon, the exchange halts trading because the circuit breakers have been triggered. Mike walks outside to get some air. He looks at his phone and sees that the news is calling it a flash crash to the upside, which makes no sense. A flash crash is supposed to be down, not up. He laughs to himself because he knows the truth. This is not a flash crash. This is the end. At 1 o'clock, trading resumes, and the price gap's up another $5. Mike does not even try to trade anymore. He just watches. The margin calls start coming in from his clients. One hedge fund is down $50 million. Another is down $100 million. They are begging him to find them silver, any silver, to cover their delivery obligations. Mike makes some calls to the vaults, but everyone is saying the same thing. No silver available. We are sold out. The COMEX officials hold an emergency meeting and announce that they are suspending all silver trading for the rest of the week. Mike knows that when trading resumes, the price will be even higher. He also knows that his firm is going to survive because they were not too leveraged. But a lot of his friends at other firms are going to lose their jobs. The phone rings. It is his wife asking if he is okay. He says he is fine, but he is not fine. He is watching the financial system that he has been a part of for 15 years collapse in real time, and there is nothing he can do to stop it. That story is not fiction. It is a prediction. It is the most likely outcome of the structural imbalances that have been building in the silver market for decades. The only uncertainty is the timing. Will it happen this year, next year, 5 years from now? Nobody knows for sure. But here is what Shadow Wealth wants you to understand. The warning signs are all flashing red. The COMEX inventories are at multi-year lows. The physical deficit is at an all-time high. The industrial demand for silver is accelerating, not slowing down. The geopolitical tensions are rising, which always increases the demand for monetary metals. The U.S. debt is spiraling out of control, which erodes confidence in the dollar. And the public is starting to wake up. You see it in the comments on YouTube, in the posts on X, in the conversations at dinner tables across the country. People are asking the same question: is my money safe? And the answer, the honest answer, is that no, your money is not safe if it is in a bank account, or a brokerage account, or a pension fund that invests in paper assets that can be printed into oblivion. Your money is only safe if it is in something that cannot be printed, cannot be hacked, and cannot be defaulted on. Your money is only safe if it is in physical silver. Now I want to give you some practical advice because it is not enough to just understand the problem. You need to know what to do about it. The first thing you need to do, and I cannot stress this enough, is to educate yourself. Do not take my word for it. Go look at the COMEX inventory reports yourself. They are published publicly every week. Look at the registered silver inventory, the eligible silver inventory, and the open interest. Calculate the ratio of open interest to registered silver. That ratio is your warning signal. When it gets above 100 to 1, which it often does, you know that the system is under stress. When it gets above 200 to 1, which it has in the past, you know that a delivery squeeze is possible. When it gets above 500 to 1, which is where it has been at times, you know that a collapse is almost inevitable. The second thing you need to do is to acquire physical silver, but not just any silver. You want silver that is recognizable, liquid, and easy to sell. American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. These are the coins that every dealer in the world knows and trusts. You also want silver bars from reputable refiners like Johnson Matthey, Engelhard, and Asahi. Stay away from obscure rounds or bars that nobody has heard of because when it is time to sell, you want no questions asked. The third thing you need to do is to store your silver properly. Do not keep it in a bank-safe deposit box because in a crisis, the banks can freeze access to those boxes. Do not keep it in a COMEX vault because that is exactly the system you are trying to escape. Keep it in your own possession, in a location that you control. ideally in a safe that is bolted to the floor or hidden in a place that nobody would think to look. And do not tell anyone, not your friends, not your family, not your neighbors, that you have silver. The less people know, the safer you will be. Let me also address the question of how much silver you should own. There is no one-size-fits-all answer because everyone's financial situation is different. But let me give you a framework that the smartest silver investors use. First, make sure you have an emergency fund of cash to cover 6 months of expenses. That cash will be losing value to inflation, but you need it for liquidity. Second, pay off any high-interest debt, credit cards, personal loans, anything above 10%. Third, max out any employer retirement match if you have one, because that is free money. Fourth, and only after you have done all of those things, start allocating a portion of your savings to physical silver. For most people, a 10 to 20% allocation is reasonable. For more aggressive investors who see the risks that I see, a 30 to 50% allocation is not crazy. And for the true believers who understand that we are at the end of a 40-year monetary experiment, a 75 to 100% allocation to physical metals, both gold and silver, is the ultimate hedge against the collapse of the paper system. I am not telling you what to do. I am telling you what the smartest people in the silver market are doing, the ones who have been studying this for decades, the ones who have made fortunes in previous metal bull markets. They are not selling. They are buying. They are buying every dip, every pullback, every time the bankers try to tamp down the price. And they are not buying paper ETFs or futures contracts. They are buying physical bars and coins and putting them in their own vaults. That is the shadow wealth strategy, and it has never failed. Now, I want to talk about the psychological aspect of this entire situation. The mental game is just as important as the physical metal. When you own physical silver, you are going to go through periods where it does nothing for years. The price will go up, it will go down, it will drift sideways, and you will question whether you made a mistake. That is normal. That is the test. The bankers want you to sell. The talking heads on television want you to sell. Your friends who do not understand silver want you to sell. But you cannot sell. You have to hold. You have to have the patience to wait for the moment when the paper market cracks and the physical market takes over. That moment will come. It is not a matter of if, but when. And when it comes, you will be rewarded beyond your wildest dreams, but only if you hold, only if you do not let the noise and the fear and the doubt shake you from your conviction. I have been in this market for a long time, and I have seen people sell their silver at the worst possible moments, right before a big move up, because they could not handle the volatility. Do not be that person. Be the person who buys when others are selling, who holds when others are panicking, who wins when others are losing. Let me give you one more historical example that should give you confidence. In 1979, the silver market was in a similar situation to today. The COMEX inventories were low, the industrial demand was high, and a few large buyers, the Hunt brothers, started taking delivery of physical silver. The price of silver went from $6 to $50 in less than a year. That is an 800% increase. People who bought silver at $6 and sold at $50 made a fortune. People who bought at $10 and sold at $40 made a fortune. Even people who bought at $30 and sold at $50 made a 67% return in a matter of months. The difference between then and now is that in 1979, the COMEX changed the rules to stop the Hunt brothers. They introduced something called the Silver Rule 7, which limited the size of positions that any one trader could hold. That broke the back of the squeeze and the price eventually came back down. But today, the COMEX does not have the same flexibility. The market is global. The players are larger. The amount of capital looking for a safe haven is unimaginable. If a group of buyers tries to squeeze the silver market today, the COMEX cannot just change the rules and make them go away. The buyers will take their case to the courts, and the courts will likely side with the buyers because a contract is a contract. So the squeeze will run its course, and the price will go where the physical supply and demand dictate. That could be $100, $200, $500 an ounce. Nobody knows the top because there is no top in a physical market that is being drained by industrial consumption and investment demand at the same time. I want to bring this all together for you now. The COMEX is a fragile, leveraged, fractional reserve system that is propped up by the assumption that no one will ever demand the physical metal. That assumption is false. It has been proven false in every other fractional reserve system in history, and it will be proven false in the silver market. The only question is, who will be holding the silver when the assumption breaks? Will it be you, or will it be someone else? You have a choice. You can continue to trust the paper system that has been stealing your purchasing power through inflation for decades. You can continue to hold dollars that the government can print in unlimited quantities. You can continue to own stocks and bonds that are vulnerable to a crash that makes 2008 look like a picnic. Or you can take control of your own financial destiny. You can buy physical silver and hold it for the day when the paper price doubles overnight because the COMEX can no longer deliver. That day is coming. The signs are everywhere. The inventories are falling. The deficits are growing. The industrial demand is exploding. The public is waking up. And the bankers are running out of tricks to keep the price down. They have been tamping the price for years, using paper futures to create the illusion of unlimited supply. But that illusion is about to shatter. And when it does, the silver price will not just double. It will triple, quadruple, go up 10 times, 20 times because the paper claims will rush into a physical market that is tiny by comparison. The math is simple. The logic is irrefutable. The only variable is time. Before I let you go, I want to ask something. Do you remember the financial crisis of 2008? Do you remember how fast it happened? One day, everything seemed fine. The next day, Lehman Brothers collapsed, and the entire global financial system was on the brink of freezing up. The government had to step in with trillions of dollars of bailouts to keep the system from completely imploding. That was a crisis of the banking system, the system that holds your dollars, your checking account, your savings account. Now imagine a crisis of the commodity system, the system that prices the raw materials that the entire global economy depends on. That crisis would be far worse because there is no government bailout for a commodity exchange. There is no central bank that can print more silver. The only way out is for the price to adjust, and adjust it will, violently, suddenly, and without mercy for those who are unprepared. The COMEX collapse is the black swan event that almost no one is talking about, but everyone should be preparing for. It is the hidden fault line in the global financial system, the one that could crack open at any moment and swallow the paper wealth of millions of people. So here is what I want you to do right now. If you have made it this far in the video, you are part of the 1% of people who actually care about protecting their wealth. Most people will watch the first few minutes, get scared, and then click away to watch a cat video or something else that distracts them from the uncomfortable truth. But not you. You are different. You are the kind of person who wants to know the truth, even when it is uncomfortable. So I want you to take action. First, if you have not already done so, hit that like button right now. It helps the algorithm show this video to more people who need to hear this message. Second, subscribe to Shadow Wealth and turn on the bell so you never miss an update when the situation in the silver market changes. Third, leave a comment below. Tell me what you think about the possibility of a COMEX collapse. Do you think it will happen this year, next year, or 5 years from now? Do you already own physical silver, or are you just starting to learn about it? Your comments help build a community of like-minded people who are preparing for the same future. And finally, share this video with someone you care about, your family, your friends, your co-workers. Send it to them and say, watch this. It might save your financial life, because the truth is, most people are not going to hear this message anywhere else. The mainstream media is not going to tell them that the COMEX is a house of cards. The financial advisors are not going to tell them to buy physical silver because the advisors make money selling paper products. The government is not going to tell them because the government benefits from a system where people trust paper money. So it is up to us, the Shadow Wealth community, to spread the word. One video at a time, one share at a time, one conversation at a time, we can wake people up to the reality of what is coming and help them prepare for the biggest wealth transfer in history. Thank you for watching. Thank you for being part of this community. And remember, the time to prepare is not when the crisis is already here. The time to prepare is now, while silver is still affordable, while the COMEX is still standing, while the paper price still gives you the opportunity to buy physical metal at a discount to its true value. Do not wait until the headlines are screaming about the collapse. Do not wait until your neighbor is telling you about the silver he just bought at double the price. Do not wait until the dealers are sold out and the premiums are astronomical. Act now. Buy physical silver. Store it safely, hold it patiently, and when the COMEX finally collapses, as it surely will, you will look back on this video and thank yourself for having the courage to take action. This is Shadow Wealth signing off. Stay safe, stay wealthy, and stay in physical.